Welcome to Talk Tickers. We give you the essential takeaways from earnings calls. Today, we're diving straight into BLNK charging. That's BLNK. Their first quarter 2025 results just dropped.
Yeah, and it's a bit of a mixed bag for the start of 2025.
Oh, okay.
So overall revenue actually dipped year over year. The main culprit seems to be product revenue that saw a pretty significant decrease compared to Q1 last year.
Not ideal, but there was some good news.
Definitely. Charging service revenue, that hit a new record high. Really substantial year-over-year growth there. And on the cost side, they managed to bring down operating expenses. Lowest point in nearly 3 years, actually.
Yeah.
Plus the amount of electricity they delivered across their networks, that saw a strong jump year over year.
So more people using the chargers they have out there.
Exactly. Utilization is up. Gross profit margin held relatively steady compared to last year. But loss per share and adjusted loss per share, those both increased compared to Q1 2024.
Right. And cash, how are they looking there?
They're cash equivalents, and marketable securities. Well, that pile decreased compared to the end of the last quarter.
Okay, so managing cash is probably key right now. What about looking ahead?
BLNK is forecasting sequential revenue growth in Q2. So things picking up from Q1, and they expect that growth to continue in the second half of 2025. Service revenue specifically, they see that continuing its upward climb throughout the year, and they're also saying they hope to give, better visibility on their timeline to hit adjusted EBITDA profitability as the year unfolds.
Okay, so a challenging quarter overall, but some positive signs, especially in services, and an expectation things will improve. Let's dig deeper then. What caused that overall revenue decline? You mentioned product sales.
Right. Management described Q1 as difficult. They pointed to macroeconomic pressures due to the wider economy. Also, seasonal trends, Q1 can be slower. And importantly, a shift in customer behavior.
How so?
Particularly among price-sensitive customers. It seems like buyers were really focused on value.
Okay, so it sounds like BLNK's existing chargers maybe weren't hitting that sweet spot on price for a big chunk of the market.
That's exactly what they said. They acknowledged pretty openly a gap in their product range. They didn't really have a strong offering for that value-oriented segment.
Right.
And that significantly impacted their product sales figures. It suggests maybe they underestimated just how focused on price many potential EV charger buyers would be.
But they're trying to fix that, I assume. Was there talk of a new product?
Yes, absolutely. Recognizing this gap, they've accelerated development of a new charger, one specifically designed to appeal to that value-focused buyer.
Accelerated. So they're moving fast on this.
Seems like it. The target launch is Q4 2025, so later this year. It's a clear sign they're trying to, plug that hole in their lineup quickly.
Okay, that Q4 launch sounds pretty crucial for turning around the product revenue side. Let's switch gears back to the positive, that record charging service revenue. What fueled that?
Two main things there. First, higher utilization of the chargers they already have deployed. Just more people plugging in more often. And second, they're continuing to expand their footprint. More chargers out there, especially in Europe.
Europe keeps coming up. Seems like a bright spot.
It really does. They highlighted strong charging revenue growth there. It shows their presence is expanding and their market position is strengthening on that side of the Atlantic. They specifically mentioned significant EV sales growth in places like Germany, Belgium, and the Netherlands, which, naturally drives demand for charging.
Right. So even with product struggles, maybe more focused stateside, the international service plan seems to be working well. You also mentioned cost savings.
Yeah, they've been actively cutting costs. Focusing on what they can control, as they put it, implemented various measures.
And that led to the lowest OPEX in years.
Correct. Lowest in nearly 3 years. It shows they're serious about managing their cash burn, which, given they aren't profitable yet, is obviously important.
And that links back to the network usage too, right? The efficiency plus the expansion.
Absolutely. That big year-over-year jump in gigawatt hours delivered, that's the electricity. It's clear evidence that demand for their charging services is growing. People are using their stations more.
Did they mention company-owned chargers specifically? How do those play in?
They did. They've been increasing the number of chargers they own directly. That's a deliberate move.
Why?
Well, those company-owned chargers contribute directly to that service revenue line every time someone uses them. Plus, it gives BLNK more control over the user experience, the quality, and the pricing at those locations.
Makes sense. And it's not just the standard level 2 chargers, right? They're pushing into DC fast charging too. Maybe just quickly clarify the difference for listeners.
Good point. Yeah, so level 2 is what you might often see maybe at workplaces or shopping centers, even homes. Decent speed, good for topping up over a few hours. DC fast chargers, though, they're much quicker. Think highway rest stops or dedicated charging hubs. You can get a significant charge in, maybe 20, 30 minutes, sometimes much faster.
Got it. So Blink is prioritizing those faster ones.
It's a key priority, yes.
Yeah.
They mentioned DC fast charging revenues in the U.S. tripled year over year. That's huge growth. And they highlighted a deal to put in up to 50 DC fast chargers for the city of Alama, California.
Okay.
So they definitely see DC fast charging as critical for network growth and as a major revenue source going forward.
So a strategy hitting both faster public charging and just growing the overall network, especially in Europe. That UK preferred bidder status sounds like part of that.
Exactly. They pointed out they're already a leading provider in Belgium and the UK, being named the preferred bidder for a big contract in Brighton and Hope, UK, that just cements their position further and shows they can win these key infrastructure deals.
And technologically, they're trying to bring everything together, consolidating networks.
Yes, they're in the process of integrating their various European software platforms into their main global BLNK 2.0 network.
And the goal there is?
Efficiency and cost savings.
Yeah.
Having one unified system should streamline operations and cut down on, redundant tech costs.
It really sounds like managing the finances, the cash burn, the expenses is front and center right now.
Absolutely. Reducing cash burn, controlling OPEX, it's critical for them to preserve liquidity as they push towards that adjusted EBITDA profitability goal. That's basically operating profit before certain non-cash items like depreciation. The key metric investors watch for companies like Blink.
Let's talk gross margin for a second. You said it was stable. What influenced that? Because, stable margins when the revenue mix is shifting, it's pretty interesting.
Right. So in Q1, the margin actually benefited from selling a higher proportion of level 2 chargers compared to the DC fast chargers.
Ah, okay. So the cheaper chargers maybe have better margins or just dominated the mix.
It seems the mix effect was key in Q1. Now, they do expect the mix might shift more towards DC fast chargers later this year. But they also expect the growing proportion of level 2 chargers that they build themselves in-house will help keep those gross margins somewhere in the mid 30% range.
That ties into their whole make versus buy thing, doesn't it? Building chargers themselves.
Exactly. They really emphasize in-house assembly. They believe it gives them better control over reliability, uptime crucial for chargers, and just overall quality.
Makes sense. Avoids relying too much on outside suppliers too, I suppose.
Yeah, they mentioned mitigating risks like getting stuck with big minimum order quantities from contract manufacturers.
Right.
And they've expanded their own production capacity both in India and in Bowie, Maryland. That gives them flexibility, especially for this new value charger launch.
Okay. And beyond the hardware costs, what else on expense management?
Well, non-cash compensation like stock options and grants, that's been fairly steady. But they have cost control efforts running across the whole business. That includes integrating those recent European acquisitions properly, which should unlock more savings. They're looking at things like consolidating office space, renegotiating software deals, even optimizing their cloud computing setup with AWS.
Okay, squeezing efficiencies everywhere. What about that spin-off they've been talking about? Any update? Just remind us, the S-1 filing is that big document you file when you're taking a company public, right?
Correct. It lays out all the details. And the update is, it's still on track. The S-1 is public now, and the goal remains to get that subsidiary listed on NASDAQ sometime this year.
Okay. And profitability targets specifically for the service side.
Their aspirational target for service margins, long-term, is the mid 20% range. So they see significant potential for that part of the business to become much more profitable as it scales up.
So yes, they're cutting costs, but they know they need growth too, right? It's not just about saving money.
Oh, absolutely. Cost control is vital, but yeah, they know sustainable profit comes from growing the top line. That's why they brought in a new head of sales, why they're pushing partnerships like the one with Create Energy.
Yeah.
It's all about driving that revenue number up.
And finally, they hinted at maybe buying other companies? Acquisitions?
Yeah, they mentioned actively looking at potential tuck-in acquisitions. Smaller deals, likely. Companies that could help them grow faster or add some useful tech to their stack. It suggests they're keeping an eye out for opportunities as the EV charging market potentially consolidates.
Okay. Interesting times for Blink. Let's shift gears. It's time for our This Is Not Financial Advice segment. After digging through all that, what's an outrageous but plausible trade idea you've got?
All right, here's one. Playing off that DC fast charging push and the grid strain issue that always comes up with EVs, how about this? You take a long position. in companies focused on grid upgrades and energy storage. Think smart grid tech, big battery providers. And at the same time, you take a small speculative short position in a competitor that only does residential level 2 charging. Nothing else.
Interesting contrast. What's the logic?
The idea is the huge demand for fast public charging plus the very real grid limitations could force a big shift in investment. Money flows towards companies solving the high-power infrastructure problem, maybe leaving the purely residential, slower charging players behind a bit. It's a bet on where the infrastructure focus and the money might go.
That's definitely thinking outside the box, playing the infrastructure angle. Okay, here's another one. Building on their European success.
Let's hear it.
You mentioned their strength in Europe, and we know governments there are pushing EV infrastructure hard, like with the UK's local EV fund. So what about going long on a European-focused REIT, or real estate investment trust?
But which kind?
One that specifically has a strategy of putting EV chargers on its properties. Think shopping centers, office parks, maybe apartment complexes. Okay, I see where you're going.
The bet is that rising EV numbers and government support will drive huge demand for charging at these locations. That could boost the REIT's property values and maybe lead to direct partnerships with companies like BLNK as they expand across Europe. You're betting on the real estate that hosts the chargers.
Yeah, another way to play the infrastructure rollout, focusing on the location, definitely some creative thinking there.
Well, they're outrageous but plausible ideas.
True. Okay, so wrapping up our deep dive on BLNK Charging's Q1, it really was a story of two sides, wasn't it? Product sales hit a snag, facing challenges there, but charging service revenue hit a record. And they're really focused on controlling costs and pushing key initiatives like DC fast charging and expanding in Europe.
Yeah, and that new value-focused charger coming in Q4 will be really interesting to watch. It could be key to addressing that product gap they identified.
Absolutely. Now, just a reminder to everyone listening, this discussion was purely for informational purposes. It is definitely not financial advice. You should always do your own thorough research before making any investment choices. So what are your thoughts on BLNK's path forward? Did anything in particular jump out at you from their results or strategy? We'd love to hear what you think. Join the conversation.